The state of the South African economy is critical in the assessment of how quickly we can move out of the COVID-induced hole we find ourselves in, particularly as the economy was so weak heading into the pandemic. Fortunately, South Africa continues to benefit from the sustained global commodity upcycle, as evidenced in yesterday's second quarter GDP, which printed at 1.2% quarter-on-quarter seasonally adjusted growth. On a year-to-year basis, GDP printed at 19.3%, but it's important to remember that this is off a low base from last year during the height of the lockdown restrictions. And aside from the headline print, the underlying data are also worth noting, particularly fixed investment, where the recovery remains rather sluggish since the hard lockdown last year. Now, those who survive heart attacks are often strongly advised to change their lifestyles. So it is with South Africa, given its recent ordeal. In July, the country experienced the national equivalent of a cardiac arrest, in that it saw its most serious civil unrest since 1994. To comment on the economic causes and what lifestyle changes South Africa might consider making to address those causes to avoid another more serious heart attack in the future, I'm joined now by Stanlib Chief Economist Kevin Lings, Bonang Mohale, who is President of Business Unity South Africa, Chancellor of the University of the Free State, Professor of Practice in the Johannesburg Business School in the College of Business and Economics, and Chairman of Bidvest and SBV Services, as well as the author of best-selling book Lift As You Rise. Bonang, I'm not sure how you get time to do all of it, and Investec Chief Economist Annabel Bishop. Kevin, let's just start with you. What's the good in yesterday's print?
Look, I suppose the good thing was the data was actually a bit stronger than what people anticipated. Not wildly stronger, but at least it was, I guess, a surprise to the upside. And when you break down some of the components, the mining industry clearly going through a good phase, as you mentioned up front. There's no doubt that that benefit is evolving. And we've seen actually in some of the employment data that the mining industry is adding jobs, which they haven't done actually for decades. So to me, that remains encouraging. I was also encouraged by the agricultural numbers, a healthy performance coming through there. And we've known that we've had a decent agricultural season. Certainly the summer season was good, and that is revealing itself in the data. And then the other thing is clearly that we still like shopping. The retail sales data, that was holding up quite well. And that, I guess, to some extent is surprising because we're not adding the jobs back the way we would ideally want to. But obviously, some of the social spending and the fact that employment in terms of higher income is fairly resilient, that seems to be helping on the retail sale. So I think there were elements where we've known about that there has been some improvement, and that improvement continued on. I'd also just flag that there was also strong growth in transport communication sector. That to me, in terms of my forecast, was where I had the biggest surprise. Certainly land transport seems to have been a little bit more buoyant. So a couple of positives, but obviously not all of the data was good.
Annabel, what were some of the upside surprises for you in this print?
The fact that Q2 came out so much stronger than Q1, that's a very positive upside surprise. But the Q1 obviously being revised down quite a bit, and of course worryingly fixed investment. That's not nice, because obviously that portends, some weakness in future economic growth and potential economic growth. So obviously concerning there. But, for us, I think overall the real upside is that we may actually see a stronger GDP outcome for 2021 overall than we previously thought. And of course, as Michael, as you know, there's been a lot of change recently. First of all the economists revised them up to the figure to around 4.5% for this year. Then of course we had the riots and figures were closer to 3.8. Then of course we've had the revisions to GDP, and we may have been back at 4.2. Now again and of course we didn't have the revisions for the first 2 quarters of this year. Now with the data coming out for those first 2 quarters, it looks like we may even be going back towards the 4.5% mark, if not slightly stronger. My concern, or perhaps my area I'm not too clear on yet, is exactly how did the riots impact the third quarter, through the quarter, and by how much. We've got a lot of July data indicating that perhaps in some areas the impact wasn't as harsh as anticipated, but if you look at the PMI data, for example, in the July month, that was a very harsh impact, again indicating the profitability. But remember also we had increased lockdowns coming through as well. Now, we still have a little bit left of this third quarter, and we're hearing that the president may actually ease lockdown restrictions. That might give us a boost. Overall, we're still thinking perhaps a 1% 1.5% drop in the third quarter. And remember, now we're not annualizing, it's just quarter on quarter.
Yes.
So that's where we feel we are at the moment. But as you said, what are the upsides? And I think maybe overall we might see a stronger outcome. So, if we do get maybe 0.7% growth in the fourth quarter, overall we might come at 4.7. We're feeling more comfortable with the 4.5% mark, but I feel we'll need to watch this data coming out. And I suppose the overall good news is that in just normal rand value for the economy, it seems to have made quite a way of recovery against the pandemic.
Our nominal GDP already above where it was before the pandemic started. In real terms, we're still around 1.4% below that. And we'll come to some of the bad that I think certainly reflects the unrest in the third quarter in a moment. But Bonang, for you, from your vantage point as president now of organised business, what do you see as the positive upsides from yesterday's print?
I think we will take the positive 1.2% GDP growth, but because we are business, of course we are cautious because the population growth is 1.6%. So not only are we standing still, but we are going backwards. So if you do some crude arithmetic, if interest rates are say 6%, CPI is 3%, GDP must grow at 3%. So we are still at 1.2%. Now you can see this is a classical sign of jobless growth. This is what we experienced during the period of the presidency of Thabo Mbeki, where we had 43 consecutive quarters of positive GDP growth. But also it doesn't look like we taking advantage of the current commodity super cycle, the same way we missed the first commodity cycle because we just couldn't get ourselves well organized. The figures exclude the 2 weeks in July because those are going to come later. When you look at the devastation, 150,000 jobs that are at risk, the GDP impact 50 billion nationally, 20 billion in KwaZulu-Natal, you can see that we have really cut our own nose to spite our face. Lastly, to now have financial services leading in terms of contribution, it's actually quite worrying. Not mining, where we used to have 900,000 jobs, now it's 400, might be edging towards 450,000. It's not even in agriculture where you don't need skills, not even in manufacturing, but the tourism and hospitality sector, which contributed pre-COVID 9.8% to the GDP, we need to go back there because it has the potential to be the greatest forex earner. So the two industries that are really growing, generally speaking, of course, will be telcos, because we are using technology, but also cyber assurance companies. Thanks. But
you mentioned the so-called jobless growth years of Thabo Mbeki. I would probably disagree with that because if you go back to the Thabo Mbeki years, unemployment was slightly above 20%, and we're now hitting closer to 40%. What we would give for those numbers again, and there is a big debate, it's certainly in policy circles around the approach that we should take and those nasty old neoliberal policies and whether or not they've worked. And we'll come to that on the issue of tourism and hospitality. Clearly, that's so dependent on the vaccine rollout. Kevin, I want to hone in now on the bad in these numbers because there is always the risk of becoming complacent if you see the overall growth projections being penciled in at between 4.5% and 5%. What is the bad in yesterday's print for you?
So to me, the deep concern is our manufacturing sector. Another decline. The manufacturing sector is just struggling. It hasn't gone anywhere near the level it was at before COVID-19. It's clearly lost momentum. And it remains a critical sector for South Africa in terms of just the overall size, the number of people it employs. We're just not competitive enough. We're just not productive enough. So for me, that ongoing weakness in the second quarter, very disappointing, given that we know that at the start of the third quarter, it got worse because of the unrest. And overall, we just are unable to translate any benefit from mining activity, from agricultural activity into production. We keep talking about agro-processing, which I think is a critical sector. I think there's a huge amount more we could be doing there. We keep talking about beneficiation. just no progress. And so it's very clear that we are increasingly more a service-based economy, and I'm not sure that that is the ideal mix for South Africa under current circumstances. So for me, that was a clear miss. The other area which I think is overall hurting us is that when you look within the financial services component and you drill down into what's happening in the granting of credit, there's nothing happening. I mean, there's a little bit of mortgage activity, but outside of that, the corporates aren't taking credit. We're not giving anything in terms of things like personal loans, overdrafts, etc. And while I'm not suggesting we should have explosive credit, there's no doubt that the low interest rate environment is there for a reason. We should have a little bit more support from the financial sector, from the banking sector, in terms of assisting this economy at this stage. And what that suggests is that there's so little confidence. Companies are not wanting to invest and expand and take on credit. And clearly the banks don't have enough confidence in the pickup of economic activity. So to me, those are two critical areas that remain weak overall.
I just want to stay with you for a second longer on that point, Kevin. Do you see that also as a function of a lack of consumer confidence, perhaps as well, with consumers being less inclined to gear up their own personal balance sheets in such an uncertain environment, such as this pandemic has created?
Absolutely. So, I mean, obviously you're unsure about job security, you're unsure about income. You would be worried about large purchases, be it a motor vehicle or a house. Some individuals have obviously managed to actually build up an element of savings because maybe they don't have to go into work as much, maybe they haven't gone back to work, they're not taking as many holidays, etc. But the overall message is that there's a fairly high degree of conservatism within the household sector broadly. We know that confidence in the household sector is actually very weak overall. And we know that the labor market is fairly fragile. So I think it reflects also a lack of confidence at household level, yes.
Annabel, for you, the bad, and certainly for me, the bad is manufacturing, because that's where we see the greatest jobs multiplier. And I guess until we sort Eskom out and our security of electricity supply is such a key component of manufacturing, very difficult to see those binding constraints being loosened. What was the bad for you?
Well, you know, interestingly and maybe surprisingly, I'll say also mining worries me as well. And mining was good. You know, we're in a commodity boom. We've had a good outcome. The future of mining worries me in South Africa. We still have very restrictive government legislation which does not support the exploration, the new mining ventures as much as it could. We still have very difficult government legislation overall in the mining industry. And why I'm flagging this as a concern is that we're very positive and happy about the mining outcome. It's supporting GDP growth, government finance, statistics and figures, employment creation. It's not going to last forever. You know, we've already seen this mining boom starting to wane. The figures now for commodity prices are lower than they were in May. And of course, you know, that the mining boom itself is going to continue to ease. Yes, we have seen high prices from a global supply shortage and a global logistics perspective. Those are very worrying, coming through in high inflation. Probably will persist for longer given the rise in the Delta third wave around the world and the damage it inflicts. But also, of course, the same for manufacturing as well in South Africa. We have seen over a decade of highly restrictive legislation coming through on our manufacturing industry, on our production industry overall, industrial production. But of course, you know, the private sector is active in the mining and manufacturing sector. And this government legislation is not showing any sign of easing. We see the Department of Trade and Industry continue to put more and more restrictions on as opposed to fewer. We do not have great ease of doing business in South Africa. In fact, our ease of doing business itself as a metric measured by the World Bank continues to fall, not because we haven't made progress, or in fact even just stabilize, but because other countries around the world are doing much better. And many people say, well, you can't expect anything to change from the Department of Trade and Industry. They'll continue to micromanage. They'll continue to want to be in command and control of the economy. Well, that's just not good enough. If we want to see strong economic growth in our industrial sectors as opposed to the services sector, then that is the areas we need to focus in. We need to relax government legislation. It creeps through into the IRP 219 as well. From electricity, if we want to move to more renewable types of electricity. But lastly, perhaps I'll add as well, the financial services sector is a misnomer. It's not the financial services sector which has been performing well. It's actually the business sector. It's the private corporate business sector. So that sector actually is your private business sector services, all of them, whether it's accounting, legal services, any type of services, along, of course, as well with real estate, sales of homes, businesses, all types of property, and of course as well your insurers and the financial services sector. But because financial services is the first phrase at the start, people just say, oh, it's just financial services. So I would say it's cheering that business services overall are seen as quite strong, but it's not good enough, as we talked about earlier. And in fact, again, it's another situation of other areas flagging and collapsing or doing badly, and the services sector just keeping up. The business services sector, it's not because it's doing enormously better than it has done in the past. So I would agree with Bonang's concerns that he evinced earlier, and of course, Kevin's worries as well. We can't just wait on fruit to fall into our lap like the mining sector has provided. We actually need to be very much more proactive in changing the legislation now, and particularly enticing new investment into South Africa, domestically and foreign investment, yes, but also, of course, as well, really analysing why is gross fixed capital formation falling off, and what does this mean for our future? So I'd say that's the real negative for our outlook and for job creation.
And I might just add that potentially we're seeing many of those business rescue practitioners holding up that business services sector in jest, of course, to Bonang. For you, what is the bad from businesses' perspective in the number?
It's the general trend at a macro level where we're now experiencing the lowest levels of confidence, trust and hope since the Second World War. But also we now are in an unenviable position where we hold the world record for all the wrong things. We've got the highest inequality in the world at Gini coefficient of 0.6, highest unemployment rate at 44.4%. These rates are associated with countries at war, Afghanistan, Libya, Syria. Thirdly, we have the highest failure rate of small and medium enterprises, where jobs are created in large numbers. Lastly, of course, long term, we have the poorest educational outcomes to tell us about preparedness for the next 10 years of the people that are going to get into the labor market. The figures are actually quite nightmarish. We now have 12 million people that are unemployed, 11.9 million to be precise, but youth unemployment at 74.9%. 10 million young people that are not in education, employment, or training. 6 million children who don't know their fathers. 30% of households that have both parents in them, and yet social grants are 17 million, excluding the 350. If you include them, that's 24 million, and yet only 16 million that are gainfully employed. We have lost 3.2 million jobs, net 2.2 million. So that your 12 million people that are just not employed. So the level of hunger and starvation and desperation says, if we don't address it, another 2 weeks in July is coming. In fact, we are actively inviting it, Michael.
And that really is the tinder box that we're sitting on, and it's about to be lit again, as you say, if we don't address our record levels of unemployment. So I want to go around the table with this question on how we actually address those levels of unemployment. I read a very interesting piece by Michael Power recently where he likens, and to your point, Annabel, too, about being globally competitive here, our wage rates at low and semi-skilled levels are almost double that of Bangladesh at the moment. Now, I'm not advocating a race to the bottom here, as trade unions would always say, but surely we need to think about how we price ourselves in a global market for labour at a competitive rate, and how we would do this. Kevin, should we just loosen capital controls to get a much more competitive exchange rate? How would you like to see that happen? Because clearly something has to be done.
Absolutely. There's a huge road ahead to try and overcome that. My concern around wages is not so much the wage rate. Let me just put that in context. If I look at the wage rate in Germany, right? The wage rate for your average manufacturing worker in Germany is extremely high. It's way higher than South Africa, yet Germany is more competitive than South Africa. So how do countries that do have high wages, how do they become competitive? And when I look at South Africa, the bit that's missing, the key bit that's missing is productivity. So, yes, you can debate our wages relative to Bangladesh and others, and you can form these competitive sets, and I think that's a fair argument. But fundamentally, we're just not productive enough. And part of that productivity relates to training and skills. Part of it relates actually to technology. You can't be productive if you don't have the same machinery that they have in Germany. So that sophistication of technology makes a big difference. Part of it obviously relates to things like strike activity. If you want to really destroy your productivity, have social unrest and looting, that'll do it. So I think that we have a myriad of factors that constantly eat away at the productivity of South Africa, and it makes us uncompetitive. I would hate to see us try and solve that through a competitive devaluation of the exchange rate, because I think we would just then become equally uncompetitive at a weak exchange rate, and everything that we need to import would just cost us a huge amount more, and we'd fall further behind. So to me, we've got to focus on a couple of things. The skills thing is critical. The whole area around disruptions to work, the way we do strike activity, the way we have electricity outages, all of those things have to be worked at in a very substantial way to try and just improve our overall level of productivity. And linked to that is you have to have fixed investment, because we need to urgently renew the capital stock. Our capital stock is aged, it's falling apart, it's not being maintained. You can't be competitive with 30-year-old machinery. So all of it is in a melting pot, and that's what I'd like to see the focus on. But in order for that to happen, you need confidence, you need infrastructure. So when you start to look at it, it becomes quite daunting. The way I would start the process is to have private-public partnerships and try get infrastructure and get growth going and see if we can't deal with some of these issues.
So on that point of confidence, are we not looking in the rearview mirror a little bit too much here? Is it not time to start looking at what is actually happening? SAA in a public-private partnership type model now, Transnet saying it's inviting open bidders and tenders to 2 key ports. We see some movement on electricity reform. Annabel, is it time to start really recognising that the pace of political certainty and reform is actually starting to pick up on the back of a pickup in economic growth, and look at the positives?
Absolutely, if this persists and if we do see a much broader based public-private partnerships. And I, certainly would add to this discussion as well on unemployment in South Africa, that we actually need a much bigger pie. What we've seen is the pie has become very inward-looking. Smaller people are scrabbling over bigger individual slices. And here you're talking about the labour unions constantly pushing up substantially higher wages, government themselves as well. These key players, which actually push out the private sector to a very large degree, in terms of the wage negotiations, in terms of employment, in terms of business confidence, have become incredibly powerful in South Africa over the past decade or so, and we have not seen the business sector feeling like it has power, like it has ability to expand and see a strong, sustainable future. And why is this important? Because businesses really grow on risk and reward. If they believe that there's going to be good reward in the future and that they will actually gain from substantial expansion, then they employ more people. And of course, they expand their fixed investment and the economy grows substantially. For all government's noise and excitement, it is still the private sector which accounts for 70% of fixed investment in South Africa. And of course, the reality of the situation is they have very little control or power over any government legislation whatsoever. The inputs are often ignored, as we saw in the pension fund coming through from the Social Development Department with all the Nedlac communications. Yes, it's been withdrawn, but it's just one more blow to business confidence in South Africa. And while government pays lip service to increasing business confidence, saying we wish to do so, the reality is that it actually does. And I think Bonang makes an absolutely crucial point, that we are at the lowest levels ever. And we would obviously be at those very low levels because businesses don't foresee change. We continue to have a highly socialist structure in government. We continue to see that excluding business to a substantial degree. And of course, all the negatives are then pointed at business, saying it's your fault that we have low unemployment rates, etc., etc. As opposed to looking at, does government legislation actually enable strong and productive business activity as it does in other countries around the world who are having strong economic growth and low employment rates, or does it not do so? And I certainly feel it doesn't. And the reality of the situation here is that unless we actually place ourselves in a situation where we become a lot more competitive, and whether it's on the wage front, certainly that's a debate, but rather in terms of economic growth and ability to expand, well, it's not going to happen if we continue to say, well, there's nothing we can do about the Department of Trade and Industry's highly restrictive micromanaging legislation on the economy and the fact that it dissuades a lot of business activity. And the same for mining, for example, in terms of exploring new mines. If we could actually have an incredibly supportive, the most supportive government in the world for exploration of new minerals and mining opportunities, just think how many people we could absorb in the areas where we have high levels of unemployment in rural areas where many of these mineral deposits are, to actually draw people in, train them, and really have a permanent mining boom as opposed to a temporary one.
That was the good, the bad and the ugly of yesterday's second quarter GDP print with Bonang Mohale, who's recently been appointed the President of Business Unity South Africa, Stanlib Chief Economist Kevin Lings, and Annabel Bishop, Chief Economist at Investec.